Hi, I'm Victor. In this video, I'm going to be updating my analysis for Tyson Foods. If you're not familiar with Tyson Foods, they produce a lot of beef, chicken, pork, and if you eat chicken nuggets at McDonald's or your kids eat chicken nuggets at McDonald's, that comes from Tyson's. So they're the biggest protein producer in the US, and I've been a stockholder of Tyson for some time. They announced their earnings today, February 6, 2023. And I wanted to update my analysis of the company. I like to scorecard my investments, and it involves 4 questions with 1 decision. Do I want to be in the industry? Is the company operated and performing well? Is debt less than 3 times EBITDA? And I want a discount on the stock. Based on the answers to those questions, I decide whether I'm going to buy, hold, or sell this particular stock. Tyson reported their most recent quarter earnings today. It's February 6, 2023. And a couple of things out of that first quarter of their fiscal year. They went up in sales by 2.5%, which is really good to see. In 2022 and 2021, they had really good sales because people started to eat at home, and Tyson really benefited from that. So it's good to see they're sustaining that type of revenue. Inflation is propping up their prices as well, which is good for Tyson. They did repurchase a lot of shares, and you can see a measurable difference in the number of shares outstanding. And that's good because it makes current shareholders own a greater percentage of the company. So that's really good. Let's take a look at their income statement. So as mentioned, sales did go up. That's positive, but cost of sales went up in greater proportion. So that really limited their profitability in this quarter. So that is a concern. The main reason for it is labor cost and some material costs, as well as some overall, inflationary costs in their production. So they got to get a handle on that, potentially increase prices in order to get back to that gross profit margin that they're looking for. That really affected their net income. So you could see the net income drop from the comparable quarter to this most current quarter. The balance sheet for Tyson is really good. If you look at their debt, it's not very high. They have current debt, not growing. In fact, it only grew, I think, about 31 million. And then long-term growth, you look at, it went down 3 million. And you consider all the capital expenditure that the company is putting into their factories to try to automate, it's good to see that their debt is not going up. They're not financing that CapEx. They're paying it with free cash flow. Now, my favorite statement, the statement of cash flows. Net income was down on the current quarter, as explained above, and then depreciation, gets added back. So the operating free cash flow is 762, which is about half compared to the previous year quarter. And big reason for that is the drop in profit. They are putting more capital into their factories to try to automate and make their factories more productive. One thing I'll point out is the CapEx. I'm not expecting it to be a reoccurring cost or investment for the next couple of years. I'm expecting maybe a quarter or two, and then their factories will be updated, and they won't have to spend as much CapEx, and we'll get back to really favorable free cash flow going forward. Following on that point, if you look at their free cash flow for the last 5 years, in 2019, which I consider the natural year before COVID, because COVID really skewed numbers, they had operating cash flow of 2.5 billion and CapEx of about 1.2 billion, leaving them with roughly 1.3 billion in free cash flow. That's a really good year. And the year before that was pretty consistent. 2018 was fairly close, give or take. But then you go into COVID, and boy, their cash flow just screamed up because prices for proteins and so forth really went up. And now we're dealing with the operating free cash flow is more aligned with 2019, 2018. But the CapEx has really gone up. As I mentioned, they really want to automate their factories. So I've made a decision to update my model, and I'm going to use what I consider the more representative year, which is 2019. in my model. And I believe that's the right thing to do at this point. We're not going to have another COVID, I don't think. And I think they're going to operate more like they have historically. So the balance sheet is really strong for Tyson. They did us a favor and they actually do the ratios. So if you look at 12 months ended December 31st, 2022, they're on a gross debt to EBITDA of 1.8, excellent, well below that 3x. And they also provide the net debt to EBITDA. I don't use that factor, but it's 1.6. Over the past year, the Tyson stock hasn't fared so well. It's down 35%, and it's probably going to be down today 4.5%. The market doesn't like the earnings report. So it's going to be 12 months, it's going to be down probably about 40%. Looking at the 5-year, you could see that Tyson has had really good runs. The first one beginning in the end of 2018 in through all the way to 2020. And then we had the pandemic. And again, it started this really nice rise. And you see the pattern that we're seeing. It drops and then it goes up. So you're seeing this pattern where if you look at the low point in late 2018 up to the beginning of 2020, you saw a 75% rise in the stock. If you look at the rise from the trough in 2020 up to the peak of early 2022, it was an 81% rise. So it's beginning to take that shape. And if I like the company, I want to ride that upward trend and buy more shares. So I value companies based on the free cash flows that I expect the company to produce in the future, and then discount them to the current value of those cash flows. I'm starting with free cash flow that they produced in 2019. As mentioned, 2019 was the last I consider really good number for this company. 2020, 2021 were just too good. And then 2022 is an adjustment year. So I think that's a good number to start with and then grow from there. I'm taking that 1.2 billion that produced in free cash flow in 2019. I'm going to grow it by 15% in years 2, 3, 4. And then terminal value is going to be calculated at a 2% growth rate. I'm going to use a discount rate of 8.5% to get to a terminal value. Then I'm going to discount those values to today's dollars, and I come up with an intrinsic value of $24.9 billion is the value for Tyson. The market cap currently is $23 billion, so it offers a small discount of 15%. I'm going to be a buyer of Tyson, and the reason for it is the trend that I picked up on that I showed on the graph is showing me that I want to be buying now. And they also pay a really good dividend. So I like the company. Tyson performed well in Q1. I think 2.5% growth is good, but profits down due to the expenses. So they have to improve that. They are giving it focus and trying to make their cost structure go down. The free cash flow went down due to CapEx going up and then lower profits. They pay a really nice dividend at 3%, and they can more than afford that dividend. So that's a really nice dividend. I like that. PE is really low. So 2023 guidance, their sales are going to grow comparable 2022 to 2023 by 3 to 5%, in my opinion. And CapEx is going to be about 2.5 billion. They're going to be profitable and they pay that really good dividend. And the next earnings will be on May 6th. My very long-term outlook for the company is, their products are going to be in demand, whether there's a recession or not. So this is a really good recession stock for me. CapEx is going to go down over time and make the company produce better cash flow and better profitability. There's small upside on the stock and they pay a really good dividend. So revisiting my scorecard, is it an industry I want to be in? Absolutely. Especially heading into a recession. I like owning a really solid food company that I think is going to be in good shape, whether we're in recession or we get out of a recession. The company is operated well. They were really thrown a lot during COVID. They really have adjusted well. And I think the investment in automation in their factories is a really good idea to make them more efficient. You're getting a small discount on the stock. Therefore, I'm a buyer of Tyson. Hey, thanks a lot for watching the video. Hope you found it interesting and discovered something new about Tyson. Please be aware, I'm not recommending that you buy Tyson Foods stock. I'm just sharing my experience as an investor in Tyson and what I'm going to be doing. Hope you found it interesting. Thanks again for watching. Good luck investing in 2023.